as
the Trump account. Yeah.
Yep.
I think this one, there's going to be a lot more news because they're going to have to unpack a lot of things from the IRS. Is going to have a lot of guidance, right?
Yep.
Welcome back to the VLP Live Greater podcast. This is episode 34. I'm Rose Price, one of the partners here at VLP, a certified financial planner and an accredited investment fiduciary.
And I'm Chris Mellone, partner and certified financial planner. Rose, we are over the 100,000 viewer mark on YouTube across all of our videos. So episode 34, we've really made a lot of headway.
Yeah, very exciting. And thank you all for watching and, again, sharing our content with others. We really appreciate it.
Yep. So today we're going to talk about the recent legislation, the big, beautiful bill, what it means for you. You know, there was obviously a lot of stuff that was, put into this bill, over 900 pages, a lot to sort out. We just wanted to share our initial thoughts, just given the passage.
Yeah, and this was really something that, it was changing. It was evolving over time. So we're going to give more of a high-level view because, again, with any legislation that passes, the IRS has to come out with their rules, how it's actually going to be implemented. And in some cases, we've seen in the past, some things get delayed just because you have to have the systems and the processes in for tracking. But what's really interesting, what this bill really did was, in some cases, we'll kind of break it out into two different areas. One is what it made permanent, right? 2017 Tax Cuts and Job Act was set to expire December of 2025. So some of the parts of this bill has actually made some of those pieces permanent. And then the other piece we'll cover is kind of some of the temporary new pieces that are now in because of this bill for the next 4 years.
Yep. Sounds great. And I think that's the best way to break it up. So let's go ahead and dive into what was permanent or what was made permanent from the original TCJA. So the first piece, the tax brackets in themselves.
Yeah. So the one big thing is the tax brackets, which again, we have the lower 10% tax bracket. We've capped the top bracket at 37. So all 7 brackets are going to now stay the same with the COLA adjustments, which the IRS gives each year. So that's one of the bigger things because again, we are keeping that smaller bracket.
Yep. And I can't tell you how many times I got that question from clients over the last 6 to 8 months. Hey, are we looking at going back to what it was before? And finally, we have clarity on that front. The second piece that was made permanent, the SALT deduction.
Yes, but this is a big change because the SALT deduction, which is the state and local tax, it was capped at $10,000, whether you were single or married filing jointly, and they've now expanded that to $40,000. So to really unpack that, this is really a big change because if you live in a state where you have high property tax and you have state income tax, a lot of times you weren't able to take advantage of those additional taxes because you had a $10,000 cap. So this is really going to impact a lot of people who maybe were itemizing before will now be able to itemize again.
For sure. And I think across all the stuff that was covered in this bill, this was probably the biggest and most impactful. Do you think that?
Yeah, absolutely. I mean, and as we do tax planning here in our software, Lista Plan, one of the biggest things we have to go back, we were just talking about this, we're going to have to go back and review every tax planning review we've already done this year because this is really going to move the needle for some clients and in some cases be a meaningful tax deduction.
Right, for sure. And that kind of leads us into the second, that was made permanent, that's a big deal, and that's the standard deduction. So if we flash back to the original bill, that was something that was almost doubled. And now we finally have clarity, hey, you're going to get, that sort of break here for the foreseeable future.
Yeah, and if you flash back to the regular bill, it got rid of the personal exemption. So if we went back prior to 2017, you had a standard deduction and you had personal exemption. So if you got personal exemption for yourself, you were married, your spouse, and children up until your dependents. So what it really did, this bill, is it got rid of the Job and Cuts Act, got rid of the personal exemption. So that was out the door, but it raised the standard deduction. And it really had the biggest impact it had is more people were able to file 1040EZ, right? Because with the cap on SALT, with other things, they were just taking the standard deduction as opposed to itemizing. But again, this is an area that increase in keeping that standard deduction does really help those with lower incomes.
Yeah, and I thought that was a great point that you made offline to say, hey, there was a 30 to 40% pickup in people that were just able to just file the easy form and really simplify their their taxes, and it's good to see that that's going to stay permanent. The next one, the lifetime gift and estate tax exclusion.
This was a big one because there was a lot of concern. Was it going to revert back to I think it was going to be about 6 million or so. Currently, it's at 13.99 million per person. So if you're married, that goes up to almost 28 million. Now it's going to be 15 million for single filers and 30 million for joint. Again, there's some COLA adjustments in there, but this was a big concern. Estate planning attorneys were waiting patiently in the wings.
Yep.
What do we have to do? Because if you have a trust, if you have a joint trust, for clients that have that scenario who are trying to potentially take advantage of their exclusions, this is now taken away. Hey, we don't have to think about, is it going to be 6 million again? Or, if you're over that threshold. So there's not a lot of people will be impacted by that. But again, this larger threshold does make some of the estate planning a little bit more easier.
Sure. And it takes away a lot of the what ifs. And, we're fortunate to work with clients where we look at some of the numbers and we say, well, if we compound this for 10 years, 15, 20 plus years, it's always been one of those, things that's out there that continues to be on our mind. So at least we have some sort of clarity.
My favorite line, it's not the first double that counts when you're a long-term investor, it's your last double,
Very
right?
true.
If you average 7% every 10 years, you double. When you have 100,000 versus when you have 5 million, that doubles a much bigger, scenario. So this is definitely true. So let's talk about the next one. This one's going to impact you. The child tax credit.
The child tax credit, for sure. So the child tax credit increased from $1,000 to $2,200 per child.
Yep.
We'll take it. Cost of daycare,
Right.
groceries, all the good stuff. So that is a nice bump and made permanent.
Yeah, and I think that's going to help, again, our younger clients who have children who are in that kind of sandwich generation. This is also going to help offset some of their tax bill too.
Yep. And on to the next one, you really alluded to some of the changes in the personal exemption. So that, was rolled back. Obviously, that sort of flows into the standard deduction piece like you were talking about.
Yeah, so that's exempt, it was set to sunset. So that would have come back into play. We would have, and if this bill would not have passed, we would have seen the standard deduction go down and we would have seen the personal exemptions come back. But again, because of this one beautiful bill, this is now set to remain repealed.
Great. And, another piece that was addressed was health savings accounts and 529s.
Yep.
Now, there's been a lot of changes over the last handful of years, specifically 529s for things that they can be used for if there's additional money that are left in the plan. This really clarified, hey, what are some of the funds that can be used for testing, things like tutoring, therapies. I think all roads lead to more flexibility with those funds. And, when you look at, hey, should I be putting money away in something like that? I always encourage clients to.
Yeah, and this is also because, again, if we back up on the 529, you get to put that money in, it grows tax-free, and if it's used for higher education. Also now, K through 12 is in the mix, right? That was allowed in. And that K through 12 allowance used to be $10,000 a year, is now $20,000 a year. So they doubled that. So if you have children in private school before college, this now gives you a vehicle to put money in and get that tax deduction. If your state allows it, is a state tax deduction, not federal. But it does allow that tax-free growth. So that's something that, if you have parents parents or grandparents who want to also help out, this is another vehicle that can be used and give that tax-free growth. But the HSA, we don't have a lot of details on that part yet, but, they're widening the uses and eligibility for that. So again, HSAs, you don't have, that's a health savings account that's usually tied to your health insurance. One of the nice things is you don't have to use it or lose it, right? The FSA you do. So the HSA, if you deposit the money, you don't use all of it, you continue to let that grow. And in some cases, invest it. And then later, you may be able to use that when you're older and paying Medicare premiums and those types of things.
Yep. So let's talk about something that got a lot of press, got a lot of headlines, heading into and coming out of this bill. And that's the new type of savings account for children known as
the Trump account. Yeah.
Yep.
I think this one, there's going to be a lot more news because they're going to have to unpack a lot of things from the IRS. Is going to have a lot of guidance, right? Yep. This is if any child born between January 1, 2025 and December 31st, 2028. So that time period, they'll be eligible for a $1,000 seed payment from the U.S. Treasury in this account that eventually, when they turn 18, can be rolled to an IRA. So again, logistically, who's going to have these accounts? Where's it going to sit? How do you're going to have to submit for this? There's going to be paperwork involved. So we'll be interested to see kind of how this unrolls, it rolls out, and how they unpack this piece. So I think there's more stuff to come down the pike on this one.
Yeah, lots of logistics. The latest that I saw said that they are targeting having this up and running by next summer. And then as far as investment options, it's something that's going to be very similar to the TSP plan. So very simple, broad-based stock indices or bond indices. So a lot of other things that need to get ironed out there before that goes live. So a lot, that's TBD. So we just covered a lot of this stuff that was made permanent from the old TCJA Act. Let's talk about some of the things that are temporary and good for really the next 4 years.
And the first one was one that's really been in the news a lot. No taxes on tips or overtime. Now, with every good story comes limits, right?
Yep.
So first thing is they cap the tip income up to $25,000. So if you're in a scenario where this is your primary, you're a server, you're in a high area of income where you're making $40,000, $50,000 in tips, only the first $25,000 is going to apply. And for overtime, it's $12,500 or $25,000 if you're married filing jointly. And then also we have to, also with any tax scenario, there becomes phase outs.
Yep. So if you're somebody that's doing really well, hey, I'm making good money, making tips, they're going to say, hey, if you make over $150,000 as an individual or $300,000 as a couple, this does not apply to you.
Yep.
I think it's a natural extension of the way tips are given. Now everything's electronic and, added to iPads and, Apple Pay and all this stuff that you pay as you go along. But as you can see, there's different exclusions and strings attached and limits to it.
Yeah, it's a lot more trackable than whenever I was a server in the the 90s. So,
yeah.
but yeah, so that's one. The other one is the added senior tax deduction, because one of the things that didn't pass was the no tax on Social Security, right? So this can be kind of viewed as an offset for that. Chris, why don't you talk a little bit about how that's going to be set up?
Yeah, so essentially, if you're somebody who's age 65 or older, this is something that'll just say, hey, you know what? You're that age, you have higher healthcare costs, all these other expenses. You have an additional $6,000 deduction in addition to your other standard deduction, or whether you itemize or whatnot. It's a separate standalone deduction that would be given to you. And as we just talked about with the tip and overtime caveat, there also is a phase out here where if you make over $75,000, this does not apply to you. And if you make over, as an individual, and over $150,000 as a couple, this will not apply to you also.
Yeah. And so I think really here, as we sort through what this means. The great thing is, our software has already been updated. We've been kind of running through and seeing how that's changed the scenario. There's a lot to unpack. So now, if you're the RMD age, if you are doing qualified charitable distributions, all these things are now going to flow through to maybe impact some of these deductions, some of the other pieces. So it's going to be really key to kind of sit back, take some of this information and kind of see what it really does for the picture.
Yeah, for sure. And this is something that I think gives a lot of clarity. Some people are fans of these policies, others are not. If anything, it's, hey, now you know what the cards on the table are and you can plan.
Yeah, absolutely. So again, this is great content. I think there will be more to come on this bill as the IRS gives more guidance. I think we'll be able to shed a little bit more light. But I do think this is a great time if you're working with an advisor or if you're wondering how this is impacting your tax picture, reach out. We'd love to kind of, we have some great software we can kind of run through. How does this impact you? What are some of the things you might be able to do or adjustments to take advantage of some of these new tax credits and deductions?
Great. Well, as always, we thank our listeners. As we pointed out, we've gotten a lot of traction with subscribers, views, all those great things. We just remind our viewers that a lot of our topics are actually common questions that we get in conversations with clients, or they're things that are emailed into us and asked to be discussed here on air. So if you have anything that's on your mind that you'd like us to talk about, please feel free to reach out.
Thank you again.
Thanks.